What's up everyone? It's nice to see you again. How's your life going? I wish you are all alright. After watching the previous video, I expect you to still be on fire to study accounting, because we know that accounting is fun and enjoyable, don't you think? Do you know what we will discuss in this video? Yeah, if you say adjustment journal, you were right. We will discuss the adjustment entry. Does anybody remember what the purpose of the adjustment entry in the accounting cycle video? It's good if you can answer it, but for those who don't, I am willing to tell you again that its purpose is to adjust several accounts to make them match the actual period in which it happens. Therefore, the final statement will reflect the company's real conditions. We have to analyze each account in trial balance to determine whether each account are complete and up-to-date reported. Let's move on to its definitions. Adjustment journal is a journal that consists of adjustment entries to adjust several ledger accounts in order to reflect the company's actual conditions at the date of reporting. As we know, in the ledger, all accounts are unadjusted, so we need to do this to adjust them. Adjusting entries are required every time a company prepares financial statement. Adjustment entries are classified into two classifications, accrual and deferral adjustment. These two will be categorized into two subcategories again. Adjustment entries are classified into two classifications, accrual and deferral adjustment. These two will be categorized into two subcategories again. We will discuss deferral adjustment first. Deferral adjustment is classified into two subcategories, which are prepaid expense and unearned revenue. Prepaid expense means that we make payment of expenses first before using or consuming the service or goods. Meanwhile, unearned revenue means we receive cash in advance before we completing services. On the other side, accrual adjustment is also classified into two subcategories. They are referred to accrued revenue and accrued expense. Accrued revenue means that we have performed services, but we haven't received cash or we haven't recorded the revenue. This means that we still have a right to receive the payment in the future, which many of you may be familiar with receivable. Furthermore, accrued expense means there are expenses incurred, but we haven't paid in cash or we haven't recorded the expenses. To get a further understanding, I will give you an example. Let's say X corporations made a purchase of 200 reams of paper from Y corporations. X corporations then will record the transactions by debiting supply account. At the end of the period, there is a stock optimum of paper which result in the remaining supplies are 150 reams. Therefore, we need to record the use of our supplies by making adjustment entry to recognize supplies expense for 50 reams. After recognizing
Created using Powtoon.